Welcome to The Explainer. Today, we're unpacking an absolutely paradigm-shifting concept straight from the money blueprint. We're going to look at how to take one of the most frustrating experiences in trading, watching your perfectly planned setup just completely fail, and actually transform it into one of the most profitable market opportunities out there. Seriously, if you've ever felt completely defeated by the markets, get ready because we're about to change how you look at your charts entirely.
So let's jump right in with a scenario I know you've experienced. What do you do when the market literally just ignores your carefully chosen order block? Aggressive momentum kicks in, and the price smashes straight through your stop loss. It's a universally relatable pain, right? You do the analysis, you set the limit order, and boom, the market just blows right past it without a second thought. But what if I told you that this exact moment of failure is actually signaling a massive new opportunity?
Here's our roadmap for today. We'll start with the failed trade Goldmine, then we'll define the breaker block. Next, we're comparing breakers versus mitigation blocks, running through our validation checklist, and finally, executing the perfect entry.
Let's kick things off with Section 1, the failed trade Goldmine. We're looking at retail panic versus smart money opportunity. There is a stark contrast in psychology and execution here. When an order block fails, what does a typical retail trader do? They get emotional. They slam their laptop shut in frustration, or actually even worse, they start revenge trading. But institutional smart money, they do something completely different. They don't just walk away. Instead, they use that exact broken order block as a dynamic flip zone to recycle the setup. They flip their bias entirely and take an entry in the opposite direction for a massive risk-to-reward win. That failed setup isn't garbage. It's literally a gold mine just waiting to be tapped.
So, how exactly does this flip work? Let's move into Section 2, defining the breaker block, and break down the anatomy of a high-probability flip. Okay, here is the absolute key to this whole mechanic. A breaker block is basically an order block that gets invalidated by aggressive institutional volume. But, and this is a huge but, only after it has successfully swept market liquidity. Think about how large institutions manage their trapped positions. When they drive price through an order block to shift the market structure, they leave behind unmitigated positions. So when the price eventually returns to that broken candle, they mitigate those losses, which flips that old support into a dynamic new resistance.
Let's actually map out the precise sequence on the chart for a bearish breaker setup. It's a three-step process. Step 1, price makes a swing high and then dips down to make a swing low. Step 2 is the critical one. Price pushes higher to sweep that previous swing high. This is the purge of buy-side liquidity. It's a total trap. Then, step 3, instead of continuing up, the market violently crashes down through the last up candle and breaks the previous swing low. That last up candle, the exact one that grabbed liquidity before failing to hold the price, that is your bearish breaker block.
Now that we know what a breaker is, we've got to address a really common, costly mistake in Section 3. Breakers versus mitigation blocks and the golden rule of win rates.
Traders mix these two structures up all the time, but they are fundamentally different beasts. A breaker block must sweep liquidity, meaning it absolutely has to take out a previous high or low before failing and breaking structure. On the flip side, a mitigation block fails without sweeping liquidity. It just forms a failure swing, like a lower high or a higher low, before breaking the structure.
So here is the golden rule you have to burn into your brain. No liquidity sweep, cross it off. It's a mitigation block, and it carries a significantly lower win rate because it just lacks that institutional backing. But liquidity swept first, that gets a check mark. It's a breaker block, and it is a highly probable setup. That liquidity sweep is the mandatory variable that gives the breaker block its institutional power. You really need to stop trading broken support entries that don't have that sweep.
Moving right along into Section 4. Let's turn this theory into a strict procedural flow with the validation checklist to filter out bad market retests.
Before you even think about risking capital on a broken zone, you need to run this 4-step validation formula. Step 1, identify a swing that swept liquidity. Again, that's non-negotiable. Step 2, watch for aggressive momentum that completely invalidates the order block. We are looking for an impulse move here, not a slow bleed. Step 3, confirm a clear market structure shift, or MSS. And finally, step 4, ensure an unmitigated fair value gap, or FVG, sits near or right inside the breaker block. If you can check off these 4 boxes, you've got yourself an institutional grade setup. Let's bring this all together in our final section, executing the perfect entry. We're covering live chart setups and risk management. All right, here's your exact execution protocol. First up, draw a box across the full body and the wicks of the broken order block candle. That entire area is your zone. Second, just wait patiently. Seriously, don't chase the impulse move. Wait for the price to pull back and actually retest that broken zone. Third, place your limit order right at the edge of the breaker box, or if you want to play it a bit more conservatively, place it at the 50% midpoint. Finally, target the opposing structural liquidity pool for your take profit. Now we have to talk risk management because, well, this is where so many traders just hand their money right back to the market. Never ever put your stop loss right on the edge of the breaker box. Market manipulation and just general noise will frequently wick you out of what would have been a perfectly good trade. You've got to place your stop loss safely past the liquidity sweep wick. This gives your trade the breathing room it actually needs to let that institutional momentum play out.
So why go through all this strict discipline? 4. The number 4 is your answer. By strictly following this breaker block setup, giving your trade proper breathing room, and targeting the opposing structural liquidity pool, you should be aiming for a minimum 1-to-3 or 1-to-4 risk-to-reward ratio. That means for every single dollar you risk, you're positioned to make 4. That is exactly how you mathematically outpace your losses and actually grow a portfolio.
Bringing this whole thing full circle, I want to leave you with a massive takeaway from the source material. Stop letting stopped-out trades ruin your trading session. Start treating failed order blocks as high-probability flip zones. The very next time the market aggressively blows right through your level, don't slam your laptop shut. Take a breath and ask yourself, did it sweep liquidity first? Because if it did, the real trade might just be getting started. Are you going to keep letting failed setups drain your account? Or are you ready to flip your bias and trade alongside the institutions?